The system doesn't break when everyone is watching. It breaks when something vital begins disappearing in silence. Right now, silver supply is quietly draining, while financial stress is quietly rising. And history shows that combination rarely ends smoothly. This is Global Pulse. I'm Sophia, and today we're uncovering a warning hidden inside the numbers. Because on the surface, everything looks normal. Markets are open, prices are moving, commentators are debating inflation, interest rates, and growth. But beneath that surface, a quieter shift is taking place. One that doesn't generate headlines, one that doesn't trend on social media, but one that historically precedes major market repricing. And it starts with supply. Over the past several months, available silver inventories within key vault systems have been steadily declining, not in a dramatic collapse, not through sudden withdrawals, but through a persistent monthly drain, and that matters. Because sudden shocks can be temporary, but slow depletion signals something deeper. It suggests demand is operating continuously in the background, not speculative demand chasing momentum, but structural demand tied to necessity. Speculation moves fast. It enters quickly and exits just as fast. But necessity is different. When something becomes essential, its demand doesn't fade when sentiment shifts. It persists, even when prices rise, even when markets hesitate. And this is where the story begins to shift from routine market movement to potential structural tension. Because if supply continues to decline, while necessity-driven demand continues to operate quietly, balance becomes harder to maintain. Markets rely on equilibrium, but equilibrium requires replenishment, and replenishment isn't appearing fast enough. At the same time, another signal has been emerging. Liquidity support within the financial system has been quietly expanding. Short-term funding injections, the kind designed to ease pressure in the banking environment, have appeared more frequently. Now, this doesn't mean crisis. Liquidity tools are part of normal policy. But historically, these measures tend to cluster during periods when underlying stress begins forming. Not visible panic, not systemic collapse, but pressure. The kind that builds before becoming obvious. Think of it as reinforcement. Support applied not because failure has occurred, but because strain is increasing. And when that strain begins appearing alongside tightening physical supply, it forms a pattern worth watching. Now add another layer. Silver is often described as an industrial metal used in solar technology, electronics, energy systems, but its role extends far beyond consumer applications. Silver sits at the heart of precision technologies, high-efficiency electrical systems, advanced communication networks. In periods of rising geopolitical complexity, materials like this shift from optional inputs to strategic resources. When that transition happens, demand changes character. It becomes less price-sensitive, more availability-focused, because in strategic environments, access matters more than cost. And when availability begins tightening, markets don't adjust smoothly. They reset. Interestingly, recent price behavior in silver hasn't followed the pattern typically associated with speculative bubbles. Positioning among large financial players hasn't surged dramatically, which suggests the move hasn't been driven primarily by leveraged enthusiasm. Instead, the underlying support appears to be rooted in physical demand. And that distinction is critical, because speculative rallies often reverse sharply, but structurally supported markets behave differently. They reprice. Another overlooked factor is allocation. Despite growing awareness, precious metals still represent a relatively small share of global financial assets. Historically, during periods of uncertainty, allocation toward tangible resources increased significantly. Yet today, Positioning remains modest, meaning the sector is not overcrowded, not overowned, not stretched. From a long-term perspective, that it remains underrepresented. And this brings us back to the core dynamic. Markets ultimately balance through price, not through commentary, not through opinion, but through supply and demand. When supply declines and demand persists, price becomes the adjustment mechanism, sometimes gradually, sometimes suddenly. Now it's important to remain grounded. None of these signals guarantee immediate disruption. Supply could expand, technological alternatives could emerge, geopolitical pressures could ease, liquidity measures could normalize. Markets are complex systems, and they rarely move in straight lines. But patterns matter because history shows that sustained inventory decline, combined with rising strategic importance and increasing financial support measures, does not typically occur during periods of structural calm. At Global Pulse, our goal is not to amplify fear. It's to identify alignment, to connect signals that often appear unrelated when viewed individually. Because when supply tightens quietly, while strategic demand rises and liquidity support increases, markets eventually respond, not through sentiment, but through necessity. And necessity is one of the most powerful forces in financial systems, stronger than speculation, more persistent than narratives, less forgiving than assumptions. If the current pattern continues, the adjustment may not come through headlines. It may come through repricing, because when mathematics of availability begin diverging from the mathematics of demand, balance must return. The real question isn't whether silver moves tomorrow, or next week, or next month. The real question is whether the system supporting it is becoming tighter than it appears, because history has shown that when something essential begins disappearing quietly, the market rarely notices until the adjustment begins. This is Global Pulse. I'm Sophia, and sometimes the most important warnings are the ones hidden in silence.